Hey, good morning, everybody. We'll just give it a minute or two as a few more people stream in. Okay. So as you well know, we're sort of doing a mini global tour. We did Japan the last time, and now we're moving on to Europe and sort of a little bit of an advertorial for the next webinar will probably be China. So it's nice to be able to sort of look at different regions of the world and see beyond the headlines, hopefully, and beyond the sort of quick readings of Bloomberg and Financial Times to see what's going on slightly more deeply in a particular region. So with that, let's dive straight into the euro area. I'll sort of give you, in many ways, the analysis is driven by the Euro Stoxx 50 and those economies. So let me just switch off my camera if I can do that. Um, if I could ask to, there we go. Save on bandwidth. Brilliant. So I will stick to the Euro Stoxx 50 basically because that's the universe of investments essentially in terms of the companies that you'll be exposed to, and then we'll align it to those countries. But in the broad economic overview that you will read, we'll move a little bit between the sort of larger euro area and the eurozone. And in fact, more importantly, when you engage with print media, electronic media, social media with regards to Europe, there will be this vacillation between what your investments may lie in terms of the Euro Stoxx 50 or top companies in Europe relative to a sort of country coverage. But I'll take you there in terms of the growth outlook and then go on to a slightly more detailed overview of what I call the growth malaise in Europe and the origins and what seems to be defining that growth malaise. And one which I think ironically looks very, very similar to Japan, which we spoke about the last time. I'll then go on to talking about the omnipresent trade deals that are going on. And of course, the EU-US one is one of the biggest. And then just go through some of what I think are the sort of potential economic impacts for the EU in particular. And then also talk through some of the regional effects that you may expect from this trade deal. And then conclude by giving you a slightly deeper analysis of the Euro Stoxx 50, the countries, the sectors, and the companies, of course, that you'll be exposed to, and then compare it to the S&P 500 and the MSCI at different time periods to see how the returns you get are actually time sensitive, at least for the long run investor. Okay, so let's go on to the sort of short-term growth outlook. But before we do that, let's just separate our terminology because you do have to pause a little bit and think carefully about what do you mean by Europe? Well, so there's the European Union, which I like to think of as predominantly a political union of 27 European countries, right? And you see the list there. There's sort of the big hitters, Germany, France, Sweden, and so on are in this economic union and political union, and they share these common institutions. So the European Commission, the European Parliament that we often see in the news, the Court of Justice, not unimportant. And then there's sort of a loose, we have to be careful, not single, but a loose set of policies around trade, competition, the environment, justice, and home affairs, and so on. As I'll argue later, there's a lot of country tension relative to regional oversight, if you like, that's ongoing since the formation of the European Union. Within that, and this graphic on the left will sort of guide you by country or at least by the four criteria. What's important for us here is the Eurozone. So the Eurozone is separate from the European Union because the Eurozone is the monetary union. And that's the zone where the euro has been adopted as the official currency. And that's not the full 27 countries, it's only 20 of the 27. So many of you, I'm sure, have traveled abroad, and you'll know if you go to Switzerland, if you go to Poland, for example, if you go to Sweden, you don't have the euro as the currency, as the official currency. So there isn't a full coverage and a full mapping. So 20 of the 27 countries, and the big ones are there: Germany, France, Italy, Spain, Netherlands, Belgium, Finland are the ones that have adopted the euro. Very important to keep in mind is that fiscal policy is a national competence. We'll talk about this later, but while you have, let's call it a unified monetary policy, again, I'll talk about that later, fiscal policy is a country competence. And what the union does, what the European Union does, is to provide guidelines, right? So you've got something called the EU Stability and Growth Pact, which sets fiscal guidelines, 3% deficit to GDP ratio, and debt to GDP ratios at 60%, which have been breached. We'll show that later. But just interestingly, on the left, think of this as four criteria on this graphic. You can either, as a country, be a member of the EU, NATO, which is, of course, the military union, very important now with respect to the Russia-Ukrainian war. Are you a Schengen sort of country, which is very important for visa and immigration movement within the Schengen area, or the euro, or all four? And you can see the one I like is Switzerland's a good example, because Switzerland says no to everything except to belong to the Schengen area. So just keep that distinction in mind in thinking about how we define the Eurozone relative to the euro area. So this first graphic is the full euro area. Henceforth, I think I'll switch mainly towards the Euro Stoxx 50, which would be dominated in terms of the index by France, Germany, Netherlands, and Spain, close to 90% of the index. And then you've got Italy, Finland, and Belgium. So think of those clutch of countries. The sort of seven countries will be the dominant economic overview, will be dominant in the economic overview that I'll provide. But if we take, as the World Bank does on the graphic on the left, the full euro area, in which it covers those 27 economies, this is a struggling region, right? So you've got growth rates, 0.7, 0.8% over the next 2 years, only half that of the US. So, of course, when we look at China, we know China is an emerging market and it's fast growing. So, China is always going to breach 4, 5, 6%, and developed countries are always going to be lower. But you'll notice, if you remember the Japan webinar, the euro area looks strikingly similar to Japan, right? This is a region that has been struggling for a while with sclerotic low growth rates, and even in the advanced country sample, still well below that aggregate. Does it look any better if we take the Euro Stoxx 50s? So in other words, let's just narrow this down and say, well, okay, but that's the broad euro area, but I'm an investor, I'm interested in the Euro Stoxx 50. Does that look any better in terms of growth fundamentals? Yes, a little bit, right? So you've got an average across the ES50, as I've called it, for 2025. That's at 1%, right? So it's still, though, only 60% of the growth rate of the US. So the growth fundamentals for those economies that you see on the left here, from Belgium right through to Spain, do not look significantly better than when you take the euro area. The sort of growth drivers are pretty much Spain, and I'd sort of think Germany, if you're optimistic about Germany in 2026, but in general, it's fairly meager growth rates across the entire Euro Stoxx 50 economies. But this is an important region, right? So if you look at the bottom graph on the left, this is not a region that's, of course, insignificant in the world economy, right? Still about 10% of global GDP. That's lower, notably lower than China, right? So China's already at 18, probably should be fairly soon at 20% of GDP, um, and stuck sort of below the US. But so in terms of thinking about growth scale, the European area, the Eurozone, whether you look at the Euro as a whole, is still a key part of the world economy. So let's just turn a little bit to these sort of short-term growth outlooks to get a better sense of, are we seeing changes? Are there dynamics in the short-term growth trajectory that perhaps provide us with some sort of insight into forecast growth for the region? So the first thing to keep in mind is that the outlook for 2025, as with most of the world, to be fair, has been downgraded in terms of GDP terms by the IMF, the World Bank, and so on. And essentially, that's a tariff story. So that's not unusual. That is a sort of cost of tariff, a GDP cost of tariff that the world has borne, including the US. Has there been a turnaround if we just take the slightly longer period from 2022 onwards? There are some green shoots, particularly driven by consumption, right? So if you look at the top graph on the left, you see private consumption has been recording increases, but investment continues to lag. And we'll talk a little bit about why investments and the banking system in the euro discourages sort of, if you like, and if sufficiently large increases in investment levels. So what you see, in fact, is contraction in equipment investment and residential construction, only partially being offset by infrastructure investment, with a little bit of that coming through from Germany. The sort of turnaround in consumption hides arguably a lagging consumer confidence trend. So what you see in the bottom left is consumer confidence collapsed dramatically in the face of the Ukrainian war, energy prices, so savings start going up. And of course, on the back of higher inflation during the sort of supply bottlenecks period and the pandemic, households haven't fully recovered their confidence in the European area. And so savings as a share of income have remained fairly high. So even though you've got this recovery in consumer confidence, savings rates suggest that confidence hasn't recovered, and certainly the bottom graphic confirms that. Inflation, though, has come down nicely. So from the sort of Russian war days, where you see this big driver in inflation from energy, it's now services-based inflation. So services-based inflation, if you think of health, insurance, education, telecommunications, all sorts of things are driving inflation, but it's come down, averaging 2.4% in 2024. And the ECB, which frankly does a very, very good job, I think, we'll show this later, of guiding monetary policy and inflation in the Eurozone, is likely to meet this target by mid-2025. So we'll see inflation even come further down to about 1.7%, but of course, you've got to keep an eye on services prices. In terms of jobs, the EU unemployment rate is about 6%, let's call it that, in 2025. Probably stay in that region in 2026. The drivers of unemployment rates in the euro area would be Spain and Greece, and those are well known. The public finance problems that Greece has always had, and Spain, with a very high youth population, has always had these extraordinarily high unemployment rates. But they continue to record declines. I think as Greece turns around its fiscal situation, and Spain, as growth rates are really high, you see unemployment rates coming down. So one important point about monetary policy, so I mentioned earlier that fiscal policy is set by countries and they have fiscal independence, if you like. The ECB, though, in terms of monetary policy, is different, right? So you have this common monetary union. That's why you have the euro. So the ECB does set a single interest rate to fight inflation as one block. So when I say the 2.4%, it is a sort of ECB defined target, right? And the ECB defined target at close to 2% inflation must be understood as a synthetic target because each country has its own domestic inflation, right? And so if that sounds messy, it's because it is, right? And you'll see as we sort of peel off the different layers of the European Union and the policies and the regulations that this is a messy union, right? So even though the ECB sets monetary policy and sets the interest rate and has these three main pegs, you see there, the main financing rate, the rate at which banks borrow for 1 week, the deposit facility rate, what banks earn on overnight deposits, and the marginal lending rate, which is this overnight credit rate. And that's consistent across all banks in the Eurozone. So those who adhere to being part of the monetary union, it's not true that interest rates are the same across countries. So think of the ECB almost as a patriarch or matriarch that's trying to guide troublesome children. It's probably an unfortunate comparison, but giving advice, but not everybody necessarily takes it. So you can end up with very different country-based inflation rates, which the ECB then uses as a synthetic mean or median weighted average to guide its interest rate policy. Which is why, given this tension between monetary and fiscal policy in terms of the European Union versus country-based targets, even what the EU calls its general government deficit is not an actual number, right? It's not the EU's deficit. It's an average of the country deficit to GDP ratios. And that's really important to keep in mind. So countries are running their own deficit to GDP ratios, their own debt to GDP ratios. And what you have is an EU GDP weighted average that's reported. So, but that's still important as a guideline for how the euro area is doing or the eurozone is doing, and you'll see there in both graphics the sort of the range of debt to GDP ratios. So remember, the EU sets this through the initial act that they have. They set this target of 60% debt to GDP ratios. Well, they're way off that, right? The average debt to GDP ratio in 2024 was 82%. And the big sort of drivers or the big debt to GDP countries or the high debt to GDP countries are the ones at the bottom there that I've listed. Belgium, Greece, we know, Spain, we know, but France and Italy are important because they're relatively new. Greece, in particular, has had, of course, long run problems. And you may have seen the ratings agencies react to France recently. And so these debt to GDP ratios, particularly for large dominant economies, are an important signal for fiscal austerity or the lack of it in these countries. So as you can see, 11 of the 27 member states that are in the full euro reported a deficit to GDP ratio that was higher than 3% of GDP. And that's the top left figure. So in many ways, can we, I'm trying to think of a fair enough conclusion. I think that would be that on average, deficit to GDP ratios are above what the ECB would find acceptable, and certainly debt to GDP ratios driven by 5 countries are much higher than what would be considered comfortable by the ECB. So I think that's an important sort of conclusion to keep in mind if you're thinking of weak growth rates that in addition are within an environment of let's call it uncertain, weak macro or poor macro discipline. In terms of interest rates, which the ECB, as I said, does set, you can see the evolution where the ECB has cut rates 4 times since the second quarter of 2024, 25 bips each time. And so you're sitting now with a 2.25% interest rate within the euro area, and that's what the banking system through those three different rates adjusted accordingly, right? With that anchor rate, our repo rate, as it were, 2.25, the banking system in the in the euro area will rely on to make loans and fund projects and so on. Um, Now, there was so an interesting point about yield curves for this period is there was a significant move apart from the usual sort of day-to-day moves in the euro area yield curves. In mid-January, both the Treasury and the Bund yields, in particular the German bonds, fell amid weakening growth prospects. But then in March, there was a fiscal stimulus announced by Germany, right? Which drove these 10-year German government bond yields up by around 40 bips. Some of you may remember that. That was a significant shift, right? And other euro area sovereign bond yields followed suit. The reason was that Germany announced a massive fiscal stimulus plan, which was in the news at the time. That meant at least traders felt that this meant inflation was coming because of the fiscal stimulus and drove yields up, right? Turns out, and I think the bond traders should have known this, right, is that the fiscal stimulus wasn't going to happen in 3 months, right? It was going to be drip fed into the economy. And so long-term interest rates have now declined with the realization that the stimulus package was going to be gradual. So I think, but the key point here is that yield curves, at least in this period, are focusing quite heavily on fiscal stimulus or lack of fiscal stimulus plans from the euro in this period. What about the currency? Well, so, and I think this is something that's also well known, is after a period top left diagram, for a long time, almost on par that was the euro and the dollar, but suddenly in the last sort of from the mid last year, the euro has strengthened significantly against the dollar. A lot of this is to do with the underperformance of US equities, the rise in US Treasury yields, as we know, by this weakening of the dollar, which has been a big feature of the world economy since the beginning of this year. A lot of capital has pulled out of the US as there are concerns about the US economy, the frothiness in sort of tech stocks and so on. And so you now have a euro dollar exchange rate that was last seen in September sort of 2021, much, much stronger euro. Notably, this appreciation is fairly broad-based. So you've seen significant gains in the euro against a whole range of currencies, right? Not just the renminbi, but also other EM currencies and even pound sterling. Um, Now, we've seen a drop off recently, so obviously I haven't sort of updated this to the exact month that we're in now, but post tariff day announcement, concerns abound with respect to the euro's growth prospects, the fact that perhaps the European Union had conceded too much, and suddenly you've seen a weakening of the euro. Bank lending activity, right, despite stable inflation rates, promises of a fiscal stimulus and so on, haven't really recovered significantly. So you see the blue graph on the left, and that's a broader sign of arguably lack of innovation, lack of risk taking in the banking system that feeds into the broader growth malaise that I'll talk to in more detail in a minute or so. So, with that sort of short run, what I'd like to call sort of bite-size fast food intake of the European Union, let's step back a little bit, right? Which frankly I enjoy a little bit more because it just allows you to think about long-run growth dynamics a bit more carefully and ask the question, has this, we talk about, Europe is struggling and so on, but is this a 2-year story? Is it a long run story? And so let's dig a little bit deeper into the origins of Europe's growth story. And it is a growth malaise, right? I mean, if you look at the top left diagram and the line graph, the green is the euro area, and of course the blue on top is the US, and we're comparing GDP per capita over the period since 1960. And so in the 60s, 70s, and 80s, let's say, let's be generous, essentially the euro area was tracking the wealth of the US on a GDP per capita basis. But follow that green line since the 80s, and you see this great divergence. There are some exceptions like the Netherlands and perhaps in the 2000s, in the 1990s, perhaps for France. But in general, almost every single major Eurozone economy, Germany, France, Spain, Netherlands, and so on, have all lagged US GDP per capita growth rates. In other words, they've become poorer relative to the US. So what you have is, in essence, a great moderation, as the literature calls it, right? That following the oil crisis in the 1970s, Europe grew, but not at the rate that the US grew its wealth, its GDP per capita, right? Not talking about the distribution of that wealth, but certainly on a pure GDP per capita basis. Um, and you did see some movement in the 80s with the Euro region integration. So as we move into the Euro area, there was this hope that you're going to see this massive boost, and arguably this hasn't happened. All right. So the promise of the European Union has not been delivered, and I think in economic terms, and I think that's almost incontrovertible at this stage. So if you look at the period, even in the bottom graph, right, GDP per capita of the euro area was 87% of the US in 2009. So if we just take a more recent period and say, well, how bad has this performance been? It's now 54%. So in other words, the ratio of the EU's GDP per capita to the US is now at a level last seen in the 1970s. And so a strong evidence of the secular decline. So let's ask the question, right? So what are the reasons? What are the factors that have caused this European growth malaise? And I go through a few of these just to give you a sense of where these growth obstacles lay for Europe. And excuse me, and will give you a better sense of how difficult the turnaround may be. So the first is, and a lot of it sits in the supply side, right? That you've got these significant productivity differentials. So if you take your growth accounting, which is, I guess, the economist's first toolbox. So let's look at capital, labor, land, if you like, and let's look at productivity. Let's look at those differentials, and you'll see that Europe's large leading firms lag in terms of productivity and innovation relative to the US. This is 2024 figures, and in every single sub-region or even country choice, so even if you take France, Germany, Italy, Spain, and you say, well, we're not interested in Eastern Europe or Central Europe, we just want to take the big hitters, still, whether it's labor, whether it's capital, whether it's total factor productivity, their growth rates are much lower than their US counterparts. If you want to take growth rates in productivity, so since 2000, productivity growth amongst Europe's non-tech firms barely breached 1%, so 0.9%. In the US, productivity growth was 2.5%. In the tech sector, even more enlightening for me is Euro's listed firms' productivity declined by 0.3% per annum, as US firms, tech firms' productivity grew at 1.5% per year. Productivity of US listed tech firms has increased by about 40%, right, over the last 20 years. So whereas tech firms have become this sort of, through productivity increases, become a driver of growth. We know this, right? We've seen it. Almost we've lived through it, right? Uh, European tech firms have actually stagnated. And except if you, certainly I'm not a sort of high-tech expert, but I challenge you to name five major European-based tech firms, whereas I'm sure we can name 10 for the US. In addition, which leads on from and is collinear with this productivity differential, right? US firms are dynamic, right? So I'm comparing these firms to US firms because this is the core of our advanced country sample in the world economy. R&D expenditure of European tech firms has been, as a proportion of sales, about 3 to 4%, right? The US R&D spend has been three times that, reaching 12% of sales in 2023. And you look at R&D intensity as a proportion of sales in the graphic on the left, and it's very, very clear, right? And this is something that's been cumulative. So even though you see it annually higher than the European estimate, remember that cumulatively over the years, this starts building up, right? And so, in many ways, what you've got is high patent activity, high levels of innovation, driven by this R&D spend by US firms that far exceeds that of Europe. I would hazard a guess, right? I don't have this exact sample to compare it against, but I would hazard a guess that China would be similar to, at least in the early period, and then higher than the US in the last 5 to 6 years. So if you needed a sort of a snapshot of dynamic innovation and growth, where productivity advances are going to come from in the world economy, this graphic with China in it probably summarizes it quite well, and where they won't come from. That ultimately means that you need to start looking at firms, and scale is one measure. So a European company, so the graphic on the left is again useful, that's been in business for 25 years is on average 1/8 the size of a similarly aged US firm, right? So a 25-year-old European company is going to employ on average about 10 workers, but a similar aged firm in the US is going to be employing 70 workers. So in many ways, yes, small is beautiful, but at some point you do need to reach scale that reflects on growth and dynamism, and increased market share. And I think this is symptomatic of the challenge in Europe of sort of small micro enterprises that are more family or location based rather than looking for market share and scale. Very, very similar in some ways to the Japanese challenge in one aspect. So what Europe actually needs, right, is young, high growth firms that will grow to scale, right, in order to reduce innovation and productivity deficits with the US. But it's very hard to find those firms, right? If you look carefully, most of those young firms, as we'll show later, actually end up moving to the US in search of capital. What you have is very few European startups, dynamic, innovative firms that actually stay in Europe. And so what Europe is left with then are these large numbers of small, old, low growth companies. That are not globally competitive. And so to lead on that point, Europe is not unimportant as an incubator, right? So you do have companies, and we'll talk a little bit about them later, that are pushing the boundaries, particularly in the Netherlands, for example, on microchips and so on, Germany in industrial engineering, that are at the innovative frontier in some aspects of foundational science and tech, right? Um, and pharmaceuticals and bioengineering are one good example, as I said, in microchips in Netherlands and so on. But the problem is those companies don't seem to stay. And so what seems to be happening is that unicorn companies that are founded, that are started in the European Union, leave the European Union for the US. And they leave it at a rate 120 times faster than the other way around. Simply put, You have an innovative idea at the frontier of science, at the frontier of technology. And if you're in the European Union, chances are you're going to struggle to get capital. We'll talk about that later. And you will then relocate to the US. And it's not happening the other way around. So, and that, what that does, of course, is to reinforce a low growth pattern. But we spoke earlier about these 27 economies, 20 of which are part of the Eurozone, and then you've got independent fiscal policy, sort of a domestic inflation that's heterogeneous across these countries by some sort of European ECB set monetary policy. And I said, does it sound messy? And chances are it does already. But if you start looking at intra-EU trade barriers, so remember, this is now even within a union where the currency is the same, there are these significant trade barriers. So between countries within EU trade barriers are significant. And they're significant for both goods and services. And some really sort of good work has been done by the IMF on estimating these intra-EU trade barriers. And this is for 2020. You look on the left for goods and for services, and you look at the trade costs as a percentage of trade, and you see significant values there. Cost margin for goods are about 44%. So I'm assuming that I need to go back to that article, but I'm assuming that's a margin, a sort of price hike at the margin at a percentage level that you would lob onto the product as it travels between countries. Um, if you look at the average for services, so for goods, the cost margin is 44%, and for services, it's 110%. Those serve as significant impediments to trade. Um, essentially what you have is a lack of harmonization of goods and rules and regulations as countries move goods across the border. Simply put, right, let's think of selling olive oil moving olive oil produced in Spain to France, right? What that means essentially, let's just take oil products in the top left here, is that in order for it to move from Spain to France, that are both members of the Eurozone and the European area and the Schengen and NATO, is that France, on average, let's assume, will slap on about a 40% margin increase because of the barriers that result in moving this olive oil from Spain to France. And so poor border infrastructure, procurement rules, and the lack of these harmonized systems across countries means that you've got significant barriers to trade within a region that is supposed to be a sort of free trade area. And this is not something that's unknown to the EU authorities. So you have a lot of sort of policy pressure from Brussels with respect to countries and these barriers that they enforce both wittingly and unwittingly, deliberately and unknowingly between countries. Let's take the idea of immigration and, well, let's go with skill shortages in the context of movement of bodies and humans across borders, right? There are significant barriers to entry for workers moving across borders. So if you go from the Netherlands to France or vice versa, estimates show it can take up to 6 months for an EU worker who relocates to another EU country to be legally employed there, right? And that's everything to do with documentation, with skills assessment, and so on. So some intended, some unintended barriers that exist. The skills shortage, though, is a biggest problem, is a more macro problem for the EU, right? Not only the trade barriers, but also the fact that many of these economies, like Japan, have aging populations, right? And so, on the one hand, you've got these high barriers to entry for, let's say, non-EU residents coming into the region, but on the other hand, skills-based shortages exist in many of these countries. Um, Even if you look at the existing stock of human capital, so even if you look at skilled workers, say in STEM, with degrees in STEM, the EU underproduces these individuals relative to the US. So even the skills production rates within the EU are much lower than the US. Um, you've got this mobility challenge, and then as a consequence, as the bottom left diagram shows, you've got these large vacancies that are now showing up in skilled positions. But yet the EU still lags many advanced countries in particular, not just the US, but Canada and Australia, in being able to attract high skilled immigrants. Um, there's also a if you're thinking more about skill shortages and in particular the idea of how skilled workers within the EU function at a management level. I found this very interesting study done by the National Bureau for Economic Research looking at US multinationals relative to EU, well, cross-country uh, companies and looking at their management practices, and they derived a sort of score of efficiency. And what they tend to find is that US firms are actually much better in terms of management efficiency, management productivity, whether they're looking at marketing and sales across different markets, whether they're looking at sort of managing staff and so on. The data and the sort of scores that they derive from analyzing all these different companies finds that US firms' management practices are probably the best in the world, followed by Japan and then Germany and Sweden, but then the rest of the EU actually lags quite a bit. Um, and so in many ways, the argument that EU business schools maybe are not teaching the right things or aren't teaching innovation or not teaching efficiency is not true. So they looked at the curricula of these EU business schools and the American business schools, and they found that the curricula were the same. Um, uh, can it be culture? Well, that may not necessarily be the case, right? Because Spanish culture is different to French culture, is different to Italian culture. So either you accept that every single culture is worse than the American culture, which seems a bit of a stretch. So it can't be culture influencing management practices. And then the argument then falls back on the fact that regulations and laws that many of senior management in European firms are facing as they try and expand, firstly into the European Union, are so onerous that it actually makes them less efficient, makes them less dynamic, disallows innovation, and so on. So again, we come back to this morass of country-based regulation, country-based practices that seem to prevent dynamism in many European firms. But the capital market also looms large. Unlike the US, EU's financial markets are actually dominated by banks, right? And they are old style banks, a bit like the Japanese. They favor physical collateral for loans, right? But if you're a young tech company in the venture capital space, you don't have that, right? You don't have large buildings or pieces of machinery to put up as collateral, right? And the bank dominated financial markets in the EU are unwilling to take these greater risks, right? And so innovation, right? Capital funded, venture capital funded innovation is in severe shortage in the EU relative to the US. And this diagram on the top left shows that very clearly. Um, EU firms also rely less on equity as a consequence, right, relative to the US competitors. Um, if you look at US listed firms, they're able to issue twice as much equity as EU ones, right? And as we know, giving equity is the only sort of, if you like, tool in the box of venture capital firms that have an idea, right, to solve a market problem and so on. And so that then disallows many EU firms from actually innovating, from launching, from challenging US firms in the tech space. So what you have effectively is, and just overstated to make the point, is old style, old school banks that have access to capital in the EU, not willing to take risks, look at tech firms as far too risky because they lack collateral, and in that context, have prevented productivity and innovation in the tech space and elsewhere in the EU. Uh, Again, regulation rears its head, right? So even in the EU, what you've got are capital markets that are very regulated and complex. So if you're sitting in Spain, there's a whole set of capital market regulations that pertain to you raising capital, and there's a separate set for France and so on. And so the EU has 18 clearing and 21 settlement markets. In many ways, well, the US has just one, right? In many ways, you start asking the question when you look at the economics of the EU, is this the EU or is it really, in effect, a set of 20, 27 countries with their own regulation, their own capital rules, and so on? If you ask firms, so if that's what the analysis shows, the firms by their own reporting back refer to these high barriers and significant differences in regulation across all the markets that they operate in within the EU. And whether you look at EU exporters, whether you look at construction firms, SMEs, large firms, services, the point of this graphic is to show that the regulatory concerns are not confined to a particular type of firm or particular sector. And so effectively these high trade barriers or even non-trade barriers, right, mean higher costs are being borne by EU consumers and companies, right, in the B2B space, and effectively prevents competition through higher prices and lower productivity being the outcome. So of course this is not new, right, to EU watchers or analysts within the EU. And you've got the Draghi report, the former president of Italy called for this. He's a well-known central banker. But it does seem, right, if you look through it, that so these reports have said, well, we've got to deregulate the EU, we've got to get rid of trade barriers, got to free up capital markets. But if you look through it, the EU is a long way away from capital market integration, and and you can see how that has prevented sort of full exploitation, if you like, of growth, of innovation, of productivity, and of capital across the EU. One metric, the total market capitalization of all the EU stock exchanges was about $12 trillion in 2024, 60% of GDP of participating countries. By comparison, the largest stock exchanges, the two largest in the US, of course, right, come in at 200% of domestic GDP. So effectively, the US through those stock markets is able to galvanize capital in a way that the EU is just unable to do so. And the idea that if you combine the strength, the individual strength of all these economies into a single unitary capital market, you can reach the kind of heights of the US economy in terms of market cap is an obvious point. But country protection of sort of country independence, refusing to let go of securities laws, definitions of protection of consumers, and so on, has meant that that ideal is far from being achieved. So let's just dig a little bit deeper onto the regulatory complexity. What does it actually mean, right? So you actually, so I said some of it's unintended and some of it's deliberate, and you do see overt protection by member states. In fact, there's even a term that if you read this literature, they call it gold plating, where members states pile on local requirements when transposing EU single market directives into domestic law, right? And so, for example, there may be an EU directive which says the olive oil can move from place A to place B, from France to Italy, sorry, from Spain to France, and that's the EU directive. it's possible that France would then issue specific country directives about the olive oil, labeling requirements, inspections, weight, color, who knows, right? All sorts of non-tariff barriers that we're aware of, even as South Africa, trying to get our fruit, for example, into other markets. And what that does is increase cost, increase inefficiency, and increase prices for consumers. So there has been a push though. So the idea has been, okay, the goods market is what it is. Let's go for deeper integration in defense, energy, telecoms, and finance. And that has been even harder, right? Because it goes to the core aspects of sovereignty, right? So a true savings and investment union in the financial services sense, if you think about the US, right? Um, is more than just having a securities regulator in Brussels, right? You've got to harmonize insolvency rules, corporate law, tax law, right? You've got to have pan-European pension vehicles, right? So if I'm an Italian government worker, I don't have an Italian pension fund, right? I would have a European pension fund. You can see the challenges, right, for countries that are, and think of our own, right, that you would fear the loss of your financial independence. Um, so while the single market gives you this obvious economies of scale, right? These are individual countries with their own independence directives, with their own identities, right? And run the risk for weaker countries of losing domestic industries, right? And you think of the politics of that at the country level, and the difficulties are obvious, right? So a union of capital markets, some member states, maybe with weak financial markets, would be extremely vulnerable to a massive exodus of domestic savings from their financial systems, right? The EU defense sector, right? If that was consolidated, how would member states be able to access weapons in a crisis? Think of Finland on the border with Russia. If national barriers to mobile telecom consolidation were removed, who controls the infrastructure? Who controls telecommunications in a country? And so the ways in which countries will obviously protect themselves is to set country-based regulations. And so that in many ways, whether it's regulation, whether it's trade barriers, poor productivity differences, lack of innovation, banks that don't seem to be able to raise enough capital for want to be able to support innovative firms, goes to the heart, I think, of the European growth malaise. And I can't, frankly, from my perspective, I can't see a quick turnaround being possible unless somehow miraculously country independence gets subsumed at the altar of sort of higher growth rates that may or may not eventuate for all countries. So I thought, just as an example of one country, the sort of almost the gorilla in the room is Germany, right? And to give you a sense of how Germany is struggling as symptomatic of the challenge within the euro. Um, so it is dominant because it's 25% of the euro area's GDP. So Germany is a significant part of the euro, but it's been stagnating. If you look at the red line on the left, at least over the last particularly 5 years or so, its GDP per capita has significantly lagged that of the OECD, and of course that of the US, and in that way mimics what's happened in the euro. But Germany's challenges maybe are slightly different to other countries within the euro who have their own challenges that some are more prominent than others. But it doesn't lack jobs, it lacks workers. And if that sounds like Japan, it's because it is exactly like Japan, right? So the demographic position means that you've got 20 million workers that are expected to retire over the next 10 years, and only 12.5 million will enter the labor market in search of work, right? So, excuse me. So what you have is a position of a labor shortage, right? Older people are retiring out. There's, of course, a pension challenge there, but you've also got this aging population where a shortage of labor develops, labor costs are spiking, and that impacts directly on Germany's competitiveness. Another aspect of Germany's sort of growth malaise has been German manufacturing, right? So this is a really interesting sort of space. Is that if you think of, if I mean, we can almost look at our own experience of access to German manufacturing in the form of household goods that we bought, right? So it was always the best washing machines and the best ovens and so on were made in Germany. But that has changed, right? And so they've lost their competitiveness on the back of increasing competition from China and I would argue Korea as well. And German manufacturing of old, the sort of stock in trade of the core part of German manufacturing, has lost global market share. And you see one of the key reasons, so you see that in the top left, the panel B on the right, you see Germany's export performance has declined in manufacturing. But you look at one of the reasons is also unit labor costs have gone up. So cost competitiveness has been lost to China, right? And so the response, though, this is really interesting, is that German firms have now moved and pivoted to higher value added manufacturing, like in chemicals, for example, where labor costs are not as critical. So the sort of movement away, let's say, away from standard stock in trade, core manufacturing, industrial goods, household goods, white goods, and so on, is now a market dominated by China and Korea and other Asian giants. And because of the incontrovertible labor cost difference, Germany has moved into higher value added manufacturing. But it's also an economy that has changed fundamentally, right? Away from manufacturing into services. And so the structural transformation that's occurred in Germany is also important. And so Germany now, bottom left diagram shows Germany's sort of business services and communication services component as a share of GDP has risen dramatically. And so you have to ask the question, is that sort of once famed German manufacturing excellence a thing of the past? And so put a pin in it, right? I think in 5 years, we're going to look at this, and that's going to include the car industry. If you look at China's rise in the in the auto industry as well, relative to Germany. Um, in the same way, so Germany almost ends up with stranded assets, if you like, not in the climate change sense, but in the global competitiveness sense, because they sit then with these legacy technologies in these once famed manufacturing hubs, right, in autos, mechanical engineering, and chemicals. Um, Whereas, the new competitors, the Chinas and the South Koreas, pretty much like Japan did to the rest of the world, didn't have any old technology. They didn't have any technology. So they immediately moved to the highest front end, frontier level, specialized technology and able to produce these stock in trade manufacturing goods at much cheaper prices. And so Germany then is stuck, right, with this capital on the balance sheet that is obsolete, right? And so in many ways, you do see that playing itself out as a growth trap for Germany in specifically in manufacturing. So the economy finds it very difficult to diversify into high-tech sectors, right? Um, that's then combined with R&D spending or venture capital spending, which looks like the rest of Europe, right? So banks dominate the German financial system, and they are unwilling, unable. There's a path dependency in what credit they provide, and they don't provide sufficient credit to innovative and high-risk businesses. Um, you also have sort of a lack of large institutional investors that are willing to invest in European venture capital. So again, pension funds and the like, either because of regulation, because of past behavior, are not willing to invest in risky ventures. And so a country that potentially, right, could act as the hub of innovation, of dynamic productivity growth through innovation, of tech, is actually stymied by a capital market that's old and very, very conservative. So just back to this labor shortage issue is that Germany faces a sort of this aging population, which generates these labor shortages. But there's an interesting ongoing debate, completely related to the tax system and work incentives in Germany. And ironically, one of the big election issues is supplying high quality and reliable childcare, right? To mothers and in particular women, many of whom who work part-time. And so the idea is if you provide cheaper, reduced tax breaks on single workers, particularly mothers with children and so on, you release these mothers into the workplace and thereby increase labor force participation rates in Germany. So that's become like a really important area of policy dialogue for Germany. But it's also an economy, given my earlier comment about this fiscal stimulus package, that has let its infrastructure spend slide. And so for many, many years, German gross domestic, well, from the public sector, fixed investment lagged the rest of the EU. And this has also resulted in slower growth rates. So the German sort of overemphasis, some would argue, on fiscal austerity has meant very little room for fiscal expansion to finance growth. Okay, so we are taking a little bit longer than I normally do, so let me speed it up a little bit. So let's now move on to the trade deal. So just keep in mind, the world's largest bilateral trade and investment relationship is between the EU and the US. Although, frankly, the way I've set it up, it almost feels like this isn't the EU, but 27 countries. But they have negotiated as a bloc. Um, but again, the truth is far from away from what Trump's statements were. That the EU is exploiting the US and so on. Well, if you look at the aggregate trade balance, right? The EU trade balance with the US, I mean, it's a 48 billion trade surplus. This isn't big, right? This isn't a massive sort of deficit that the US is running with the EU. Um, what is the substance of it? The EU is the largest buyer of the US natural gas and oil, and they also, of course, purchase US services. So that's the sort of Apple and Meta and so on. So use of intellectual property, a lot of consulting and PR services, and then the computer services and R&D. Um, Essentially, EU-US goods and services trade is balanced, as I said. It's just the surplus that the EU runs is about 3% of total trade between the two. So it's unclear why one sees this strong reaction from Trump, but be that as it may, that's the world we are living in. Um, Even so, if you look at the EU, it has limited exposure to trade with the US. 21% only of EU exports go to the US, right? Even though it's the largest trade relationship in the world. And the value added embedded in this trade is about 3% of EU GDP. So what is the deal? So at the last time of writing, and this was, this stuff changes daily, but I haven't looked at it recently. But under the trade deal that was signed, there's a 15% all-inclusive US trade tariff ceiling. It'll apply to most EU imports. And then, there's the list: cars, pharmaceuticals, semiconductors, and so on. It's higher than the uppermost rate that was applied in the April negotiations, right? And they're still talking about the steel and aluminum tariffs. The thing that's really interesting, and the EU's made these commitments, right? And so I think that was why there was a view from EU commentators that the EU gave in, where they pledged to purchase more US gas, raise its investment in the US by 600 billion. This is sort of very much in the sort of Trump mold, right? With his significant demands. But what is stated by the EU very clearly and was stated in their press release is that this is not a legally binding agreement. It's a political agreement. And so what's ongoing now, as far as I understand, are the details fleshing out the actual trade agreement. And so watch the space. I mean, we may end up effectively far away from the 15% um, that Trump initially made an agreement on. It's very similar to the South Africa US trade agreement where we were sitting at 30%, and now there's even talk, well, firstly, that we'll settle at a lower rate, but there's even talk that AGOA may be extended, in which case we're back to where we started anyway. So these things are constantly changing. So just very quickly, there are two sets of models. One, the Peterson Institute shows significant declines in GDP to the euro area from this trade agreement. Um, but then perhaps the more carefully done piece of work, which excuse me, which compares a series of models, and those are those dots that you see there, says that the US economy would actually be harder hit than the EU. And the consensus model there shows a 0.7% decline in US GDP, while EU's GDP only contracts by 0.3%, right? So, I mean, there are ranges. You can see that across the dots, but in essence, the US actually suffers more from the trade deal in terms of GDP relative to the EU. And that's why I think there's been all this discussion about the impacts of tariffs, not just on prices, but also on growth rates. And that's what has fed into these lower growth rate assumptions into 2026 for the EU and for the US. But in relative terms, the US will suffer more. What is it that's been targeted? If one thinks of it in a very sort of visual sense almost, well, for the product channels for the EU, it's going to be European cars, furniture, luxury goods, machinery, right? Um, and so you've had, for example, the German Automotive Industry Association warning that a 5% tariff alone, right, could cost the German auto industry billions of dollars annually, right? Volkswagen has already lowered its full year sales forecast after reporting this 1.5 billion cut in the first half of the year from the US. And an important sort of overlay on that is some economists are saying, well, look, increases in European car prices will vary by the brand and the model because it's dependent on location of production, right? Because if countries are producing cars in North America, well, then the price adjustment's going to be zero, right? And again, some cars are being produced in Mexico, partly with the US and Canada also involved, and so you've got this very intricate system of pricing that may affect autos that are officially EU made or EU cars. Luxury goods, slightly different because the elasticities are lower. And so you may find that luxury goods, a lot of which end up in the US, it's the dominant market for European luxury brands. Because of their higher profit margins, they may be more willing to absorb some of these higher costs. But you're also then going to see higher increases in machinery. One of the things you've got to keep in mind, though, is that you will see, so even though the GDP effects are lower in the EU compared to the US, and that number, 0.3%, seems low, there will be disparate regional effects. So in a country, if you say, for example, if you take certain regions, so if you look at the red in terms of exposure of regional EU employment to tariffs in the map on the left, look at the red areas and you'll see those areas in Germany are the auto production areas, or the areas where production destined for the US is dominant. And that's where you're going to see significant disemployment effects. And so the regional effects of EU US trade, negative effects on employment, shouldn't be discounted. So I mentioned here, Ireland is, for example, the most exposed. Chemicals, transport, equipment, food, beverages, and so on have all large employment shares with respect to those products ending up in US markets. And then Italy is also heavily exposed. So you can see what I call micro and macro effects. Macro effects may be small. GDP is relatively small, but don't discount media articles saying, you know, 50,000 Italian workers have lost their jobs because of the trade deal. All right. So then the last section really is to take you through a deeper dive into the Euro Stoxx 50, which is the investment portal that gets us access to the EU, more specifically the Eurozone and their companies. So what are you getting access to? And I thought I'll just give you a slightly different flavor of what the Signia product offers, but from the vantage point of, let's say, the economics lens. So firstly, you are effectively buying into 7 countries, right? And I think I mentioned it at the beginning, right? So and in the main, you are buying into French and German companies. Okay. So just a reminder, the Euro Stoxx 50 gives you specific weights to the top 50 Eurozone companies, right? And it's free float adjusted market cap, right? Um, so the first 40 of these companies are automatically entered, and then the next 10 are picked from ranks 41 to 60, and then that's reviewed every June. But as I said, there's a market cap, so no single company can exceed 10%. And your 7 countries, France and Germany, get you 66% of the index, right? So if you if you like to keep an eye on your investments and watching it closely, just remember if you have a Euro Stoxx 50 investment, you should be paying 60% of your time in watching this index should be picking up news on France and Germany, right? I'm sort of putting it bluntly, but in essence, those are the companies that you invested in, and there are 31 of those, and then Belgium and Finland are at the bottom of the pile, as we'll see, very few companies, but then Netherlands, Italy, and Spain make up the rest. So what kind of sectors? Well, similar to the rest of the world, you are getting into financials and industrials. So and information tech. So those are the top three. And financials and industrials make up 44, let's call it 45% of the index, but about a quarter of the index in Euro Stoxx 50 is made up of companies in financial and business services. Where are they spread? Again, it's Germany, right, which you'd expect given its dominance, but also Spain. So um, Spain accounts for at least 20% of that. Industrials are dominated by France and Germany. Um, but you tend to find, given its overall dominance, France is fairly spread. So again, the importance of this is that it's not as if you're picking up France across 1 or 2 companies, but fairly sectorally spread, right? Industrials, materials, consumer staples, and consumer discretionary. One important note is that there isn't a single real estate stock in the Euro Stoxx 50. So most countries, probably with the exception of Finland and Belgium, which only Belgium has Anheuser-Busch only in the index, have a fairly decent sector spread. So so in terms of what you are buying, so I always like to look at this and say, okay, well, what's in the index? Which are the top players here, right? So a quarter of the index is in 5 companies. So ASML, so that's your tech player, microchip manufacturers in the Netherlands. SAP is known to all of you. Siemens is known to all of you. Alliance, Insurance, and then Schneider Electric in France. So in many ways, if you wanted a company watch, spend a quarter of your time on those 5 companies. Mostly, as I said, financials, consumer discretionary, and industrials. And noting that there are only 4 IT companies in the index. So that picks up again on this growth story, right? So if we're thinking of growth and innovation in the next decade, and your view is that it's going to be tech heavy and AI heavy, Europe's not necessarily the place to be relative to the S&P 500. But if you think the world's going to get much richer, I'm just giving you sort of one thesis, and every consumer on this planet, from India to China, that's going to get very rich is going to want European luxury goods. Well, then this is a stock for you, right? So you get access to companies like L'Oreal and others. So despite its prominence, right, as we look at the Euro Stoxx 50 countries and we say, okay, but do they represent enough of the world economy? They make up 18% of global GDP, right, which is less than the eight largest emerging markets. So again, although that's a little bit of a stretch and sort of lies, damn lies in statistics, is that China is 17% of that, right? Or the majority of that 18%. The rest, India, Taiwan, South Korea, and so on, make up that EM8 relative to the EU7, which is at 13%. So in many ways, uh, if you look at a low growth story, advanced countries, um, uh, sample, Japan and the EU can be coupled. If you want high growth with a little bit more volatility, you're probably looking at your EM stocks, but that's sort of fairly well known. But in terms of global GDP and representativity, the MSCIM is probably more representative than the EU. If you once you start beginning to see the world as being dominated in essence in GDP terms by the US and China, and I think that's well known. Population. So one of the sweet spots, and I'll sort of show in the next two slides, is to have a rich country that's growing and dynamic and innovative, but also have scale, right? So Luxembourg is very rich, but they're very few people. So what about the EU's population? So it does have a larger population than the US. I didn't realize that actually. So I thought it was smaller. So 450 million people compared to 350 more or less in the US. Um, Germany and France are the largest. But notice that again, when you're in the EU7, which is your Euro Stoxx 50, your scale is only 87% of the US. Okay. Growth rates, which is not surprising, and that's true whether we look at the EU7 or the euro area as a whole. You'll see in the top left rates of GDP growth rates. We've been into that before, right at the outset, much lower than the US, and of course lower than China and India. Spain is the outlier, but that's from a very low base. Spain has been struggling for a long, long time, and Spain is much poorer than the European Union mean, and of course, much poorer than the US. And you see that in the GDP per capita figures, right? And in fact, the European Union's GDP per capita is only half that of the US. So, what you have in equality in terms of scale and market size in the EU relative to the US, you lose completely with respect to wealth. And so, whereas the US has both, right? And as I said, that sweet spot is to have, okay, you can have high growth rates, but in level terms, what you want is a large market that's rich, and still the EU falls significantly behind the US. Even if you look at rich economies like the Netherlands, Belgium, Germany, and so on, they still lag on a GDP per capita basis relative to the US. In terms of public debt, those figures are much better for the Euro Stoxx 50 than compared to the US, EM8, and China, and that's the ECB. I think the ECB does a sterling job, probably the best run central bank in the world. Um, and in essence, the EU GDP being 64% of EM8 GDP is only 53% of debt. And so this sort of dissonance between its contribution to GDP relative to its debt levels, I think reinforces its low debt to GDP, low sort of austere debt management. And I think despite the challenges that you've seen. Um, so the EU7 average, so this is your Euro Stoxx 50. If you're looking at them, is there any sort of macro crises looming? I think apart from Italy, where you may want to keep an eye on those debt to GDP ratios, the average at a 92% for economies that are as rich as these, I think is absolutely fine. And of course, those debt to GDP ratios are below that of the US and Japan. So again, reinforcing slightly better debt management. The EU unemployment rate, sorry, I'm almost done. I know we're running out of time. The EU unemployment rates, um, apart from Spain, where you do have, and Finland perhaps, where you do have worryingly high unemployment rates. I think those are manageable in the EU context, but again, much, much higher than the US, and in some cases, more than double US unemployment rates. So you've got the broader challenge of stagnating growth, aging population, undynamic firms, and so you've got this pool of unemployed workers that almost feeds on the social instability that perhaps has been rising in Europe. And you can see, if I can make a political economy point, that also feeds into the sort of rise of right-wing Europe as well. So you can start seeing elements of that. But certainly, just purely in terms of unemployment rates, the fact that you've got a region that's one of the richest in the world, seeing in some cases unemployment rates breaching 10% is concerning, but it's a reflection of those low growth rates. So what if you compared your Euro Stoxx 50 against the MSCI EM versus the S&P 500? Now, I'm going to show you three very, very similar graphics, but the time period is going to change. So I want you to keep an eye on this. I think it's going to be 4 graphs, and just see why is the time is the key determinant of the returns you would have seen. So if you take the period 2013 to 2024, the S&P 500 is the clear winner. Hypothetical $1,000 investment in 2013, value that in 2024, you see almost a quadrupling of that to about $4,000 on the S&P 500, and for Euro Stoxx only $1,500, right? And then the EMs even lower, right? So that then much higher yields on the S&P 500 if you are locked in from 2013. So what if we go the previous period? What if we took the period 2005 to 2014, right? Now the $1,000, right? And you look at the graphic, yes, the S&P 500 does well, but actually the gap between, in this case, the MSCI EM and the S&P 500 narrows, right? And in fact, if you look at the bottom, $1,000 invested in 2005, by the end of 2014, you almost had the same returns on the EM versus S&P 500. But for our purposes, Europe still lags, right? So so far, whether I look 2005 to 2014, or if I look at 2014 to 2024, Europe has lagged both the S&P 500 and the MSCI EM. But EMs actually don't look so bad in this earlier period. So then the obvious thing is, what if I look at the full period, 2005 to 2024? What if I was locked in from then? And again, time-based estimates are important. You see the differential returns, right? So over the full period, right? The US markets performance stands in stark contrast to much flatter returns, right? So you are going to get greater volatility from EMs. So they matched in the early period that of the S&P 500, but completely collapsed in this later period, 2013 to 2024. But if you wanted stable but very meager growth returns, you would have stayed in Euro Stoxx, all right? So still giving you much worse returns. And that's just another reflection of that full period where you see the same numbers. Now, what's super interesting, and I think this is my last slide before the conclusion, is that what if you went right the way back, right? And it just sort of, again, like to sort of play these graphics with you. If you took the period 1990 to 2010, and I found this old Financial Times article, well, then the Euro Stoxx 50 and the S&P 500 don't do so bad. The Euro Stoxx 50 doesn't do so badly as against the S&P 500, right? So what is really happening, right, is this long run structural shift of a US economy that has just taken off since the mid 2000s or 2010 onwards, right? But in that early period, right, you do find Euro Stoxx 50 companies, right? Those European, let's say, manufacturing frontier German, French companies, luxury brands going toe to toe with the S&P 500. It's really when you see advances in technology, big US tech stocks taking off, that you see the S&P 500 just growing at this dramatic rate. But you also have these drags that I think start accumulating across the EU with respect to growth rates that I've outlined. But an interesting other aspect is that in the financial crisis, EU banking regulations tightened in as a consequence of this crisis, and total market cap of European banks that are already conservative fell further from 2.7 trillion to 1.4 trillion. So you've got a banking system that is already old school and conservative that then becomes a smaller capital player. In contrast, the US bank market cap increased, right, by a trillion. Um, and as the US emerges from a crisis and in fact further provides further momentum to innovation and productivity through capital markets, through private equity, through asset management, Europe almost goes back into its shell. I mean, that's one interpretation of the kind of returns that you see here. One further aspect driving the divergence in returns since the financial crisis. Anyway, thought that was a super interesting way to look at returns over time, where the time period choice does differ. All right, so that's sort of again, another sort of whistle stop, but hopefully more than just a tweet version of Europe. Where do we stand? I think this is an area very similar to Japan that we toured the last time, sub 2% growth rates. Short-term change is going to be very difficult. You can see the regulatory concerns, you see the productivity problems, the firm dynamism, poor investment in R&D, the lack of tech focus or support to young tech firms. All of that gets wrapped up in a set of country-based regulations around labor laws, capital markets. And then if you overlay that with demographic and skills challenges, this is a difficult region to do business in. This is a region where growth rates are likely to remain low unless you see some dynamic change, disruptive change in the short run. And I don't see that coming. And Germany reflects that. And so you've got this intensity of the US trade deal, which has now made sort of short-run growth even harder. Um, and my view is, even if you look at if we say, okay, well, let's take the Euro Stoxx 50 compared to the MSCI, EM, and S&P 500, and don't cherry pick your time period. If I look at the growth fundamentals and looking forward, apart from short-term gains, I think on the long run, growth rates in the EU are going to struggle. All right. Thanks very much. I hope that was of some use and interest. I think there's 4 questions. Yes, so the one question from Anton is asking about military equipment building industry. Yes, that's definitely an attractive growth area. So again, if you just look at arms manufacturing, so one aspect of short-term EU growth has been this pivoting into military spending, even more so as the US pulls away from NATO and its support to NATO. So I think that is definitely an important area for short-term growth. Yeah, so yeah, exactly as you've said, they're ramping up military spending. Yes, you can get a copy of the presentation, Stian. You can definitely, that'll all be distributed by the team. So I think the impact on the EU of influx of Chinese vehicles, I think is it's a localized version of the challenge being faced by, let's call it, traditional manufacturing, auto manufacturers in the EU, right? So you do have cheaper, more modern vehicles that are greener because the technology is better. That's coming into the EU. And I think those regional consequences for Germany are going to be serious, and for France, right? And you're seeing that being played out. And I think it's going to be slowly and then really quickly. And then the next time we look, in the same way with household goods, it's no longer going to be German and Japanese cars. It's going to be Chinese and then German cars. So that's my prediction for the day. Netherlands, of course, has the a dominant. So the questions about Netherlands has a dominant chip manufacturer. They have a highly skilled population, sort of a tightly run economy, but they still struggle. How do you get access to Netherlands? Well, if you go through Euro Stoxx 50, well, you're buying into everything else. That's still a problem, right? But I think it is an area or is a country that probably is trying to be the most innovative relative to the old stalwarts, namely France and Germany. Okay. Um, I don't see any further questions. We'll make a copy of the presentation available. But I do hope this has been enjoyable, and this has been the last will be my last webinar for the year. And if I don't speak to any of you again, I hope you have a great holiday, even though it's very early. There's a lot of months still to go. And we shall reconvene in the new year. Thanks very much.